Hey everyone, and welcome to another Explainer. Man, am I excited to have you here today because we are unpacking one of the absolute wildest financial stories we've seen over the last year. Seriously, if you've been watching Wall Street between July 2025 and July 2026, you know they've been on a total roller coaster ride with Ethereum. What kicked off at this massive, almost gold rush level of institutional buying has basically turned into a brutal stress test for corporate balance sheets. Today, our main focus is all about the future of ETH reserve assets, or as it's perfectly described, Dunglai Taisan Zuchu Etish. We're going to figure out if this dream of a decentralized corporate treasury is actually sustainable, or if it's literally on the verge of structural collapse.
Okay, let's just jump right in with a number that should absolutely drop your jaw. $4 billion. That is the staggering net outflow from Ethereum ETFs in just one single month, June 2026. I mean, just sit with that for a second. We are watching a real-time stress test of the whole MicroStrategy of Ethereum model. Companies that went all in, betting their entire corporate treasuries on ETH, are facing pressure like never before.
So here's our roadmap for today's explainer. First, ETH cash flow volatility. Second, the major institutional holders. Third, the heavy loss pressure they're facing. Fourth, what happens in a sideways price scenario. Fifth, the fund and staking risks. And finally, number 6, we'll dive deep into the future of ETH reserves. All right, starting off with part 1, ETH cash flow volatility. To really grasp the panic right now, we've got to look back at the timeline of how capital flooded in and then violently rushed out. The sheer speed of these market shifts is just wild. Back in late 2025, we had the spot ETF boom, right? Institutional money was pouring in. They accumulated a record 11.8 million ETH. That was roughly $15.8 billion at the time, gobbling up nearly 10% of the entire network's circulating supply. But then, the macro environment totally flipped. The first half of 2026 hits, and a hawkish Fed, soaring inflation, and rising U.S. Treasury yields triggered a mass exodus. That $4 billion outflow I mentioned earlier, yeah, it crushed the price all the way down to the $1,500 range. Now, looking at July 2026, we're finally seeing a mild recovery, kind of stabilizing around 1,800 as funds like BlackRock and Bitwise start seeing some slight positive inflows again.
Moving on to part 2, major institutional holders. The really big question here is, who exactly is left holding the bag? And just to be clear, we aren't talking about custodian exchanges like Binance or Coinbase that just hold customer funds. We're talking about active corporate balance sheets.
Just look at the absolute dominance of Bitmine Immersion Technologies right at the top. 5.77 million ETH. That is over $10.5 billion, making up 4.8% of the total circulating supply of Ethereum. They are, without a doubt, the undisputed heavyweight champion of the corporate ETH treasury space. Right behind them is BlackRock's ETF with 3.4 million, then SharpLink holding over 870,000, and Grayscale trailing at 520,000. And get this, Bitmine isn't just sitting on their stash, they're actively staking 85% of it to generate yield.
Which brings us to part 3, heavy loss pressure. Because you know what actually happens when a corporate giant uses a massive buy and hold strategy, and then the asset's price just falls off a cliff. Let's talk about the pain these guys are enduring right now. Now this number right here, total shock factor, $685.6 million. That was the Q1 2026 net loss reported by SharpLink. Can you imagine being the CFO trying to explain that on a quarterly earnings call? It perfectly highlights the brutal, unfiltered reality of holding super volatile digital assets on a traditional corporate balance sheet. But we should probably clarify what a loss like that actually means in this context. Under US GAAP accounting rules, companies have to mark their digital assets to market prices. So out of that $685 million loss for SharpLink, $506.7 million of it was an unrealized loss, meaning it happened simply because the price of ETH dropped. Add to that another $191.7 million impairment on a derivative token called LZF. The really critical takeaway here, SharpLink literally didn't sell a single coin. It's purely a paper loss. But on a balance sheet, yeah, it looks like an absolute financial disaster.
And hey, it's not just the corporate treasuries feeling the heat. The fund managers are sweating too. Grayscale suffered the worst hit to their assets under management, or AUM, which plummeted a massive 38% year over year. A nasty combination of their high management fees and investors rushing for the exits to cash out old OTC positions led to continuous massive withdrawals. Their fee revenue has been absolutely gutted.
All right, part 4, sideways price scenario. Up until now, we've just been looking at the historical facts. But to really figure out the future of ETH reserves,
we've got to run a stress test. We need to ask what happens if the market just doesn't recover.
I want you to really think about this for a second. What happens if the price of ETH just goes sideways for an extended period or just slowly bleeds out? If you're a company trying to be the MicroStrategy of Ethereum, a flat market isn't just a minor inconvenience, it's a full-blown structural crisis.
Let's break down how this builds into a perfect storm for companies like BitMine and SharpLink. First off, those continuous unrealized accounting losses we just talked about, they permanently erode shareholder trust. Because of that, the company's stock price, which investors are basically using as a leverage proxy for ETH, remains chronically undervalued. And when your stock's in the gutter, trying to raise new capital by issuing shares becomes insanely dilutive and prohibitively expensive. Oh, and worst of all, if these companies use fiat debt or convertible bonds to buy that ETH in the first place, a stagnant price means they don't have the surplus profit to pay back the principal. The default risk just absolutely skyrockets.
Moving to part 5, fund and staking risks. So the corporate treasury model is clearly skating on thin ice in a stagnant market, but let's zoom out and look at the contagion effect. How does this sideways action impact the ETFs and the broader Ethereum staking ecosystem?
You see, ETF managers like BlackRock don't face direct price risk, right? They just collect fees based on the total assets they manage. But if the price goes sideways, their AUM stagnates, and suddenly their fee revenues freeze. And it gets worse, because Wall Street is ruthless about capital efficiency. If ETH is just doing nothing while the S&P 500 is booming, we're going to see capital flight. Money will literally sprint out of ETH ETFs to find better returns elsewhere. To fight for the remaining scraps of market share, these funds are going to start a brutal fee war, slashing fees to zero, which will force the smaller funds to either close up shop or get swallowed whole by the giants.
And this brings us right to the real yield problem. You'll often hear proponents of the ETH treasury model argue that, unlike Bitcoin, Ethereum actually pays you to hold it through staking. But let's look at the actual numbers. ETH staking yields are sitting around 2.7 to 3%, while risk-free U.S. government bonds are yielding 4 to 5% in this tight monetary environment. If the price of ETH isn't going up to make up that difference, that 3% yield doesn't even cover fiat inflation, let alone corporate operating costs. So why on earth would a treasurer take on massive crypto volatility risk for less yield than a safe government bond?
If institutions decide that the yield just isn't worth the risk, here's how a technical bank run unfolds. Step 1. Institutions simultaneously unstake massive amounts of ETH to flee back to fiat currency. Step 2. This sudden rush creates massive exit queues in liquid staking protocols and restaking layers, like EigenLayer. Step 3. All that traffic causes severe network congestion and a massive liquidity drain. Basically, institutions might not be able to get their cash out as fast as they want. It is a compounding crisis.
Which brings us to our final section, and really the core focus of today's explainer. Part 6, the future of ETH reserves. Taking all of this into account, what is the ultimate viability of this strategy?
I want to read this quote to you directly, because it honestly hits the nail on the head for this entire situation. The Ethereum treasury strategy is a double-edged sword. Without price growth to prove its store of value, Ethereum is pushed back to being purely technical infrastructure. That is the harsh reality check right there. Wall Street's big dream of using ETH as a premier reserve asset absolutely requires sustained price appreciation. The staking yield alone just isn't enough. Without that upward momentum, these corporate whales are basically just sitting on billions in stranded capital. So I'm going to leave you with this final thought to chew on. As the pressure mounts and these paper losses keep piling up, what comes next? Are these institutional giants going to hold the line, double down, and pray the macroeconomic tides turn back in their favor? Or will the crushing capital costs of a stagnant market force Wall Street to pull the plug entirely on the Ethereum treasury experiment? It is quite literally a multi-billion-dollar question, and the answer is going to define the next decade of digital assets. Thanks so much for joining me on this explainer, and definitely keep your eyes on those balance sheets.